Welcome to The Explainer. Today, we're tackling one of the most common and, let's be real, stress-inducing questions in the modern real estate world. We are going to prove that buying a home on a $60,000 salary is a mathematical reality, not just some internet myth. Seriously, forget the doom and gloom you're probably seeing on your social media feeds. Today, we're putting all that emotion aside and we're focusing entirely on the numbers, the strategies, and the objective truth about your actual buying power. Okay, let's just dive right into this massive number, $60,000. This is the financial reality for so many hardworking people right now. Yet, if we look at the 2024 data, the national median household income in the U.S. was actually sitting a bit higher, right around $83,730. And when your income is sitting below that national median, it's incredibly easy to look at the 2026 housing market and just feel entirely locked out. It is a really stressful place to be, and honestly, acknowledging that stress is the very first step to conquering it.
Because let's face it, when you contrast that $60K salary with the national median home price, which currently sits at over $435,000, it can feel like a genuine punch to the gut. You picture this classic, beautiful suburban dream home with the white picket fence, and then you look at your paycheck, and the gap between the two just seems completely unbridgeable. Now, buyers earning $60,000 will likely need to look for a more affordable home than that $435,000 median, but that absolutely does not mean the dream is dead.
Which brings us to the big, tough, anxiety-inducing question. Can you actually afford to buy a home right now? Well, the short answer is yes, but the long answer? That's exactly what we're going to unlock today. We're going to break down the exact objective math that lenders use so you can figure out precisely how much house you can afford, and honestly, more importantly, how to maximize that number. To do that, we need to shift our focus away from the emotion of the market and strictly onto the lender's calculator.
Section 1. Math behind the mortgage. Objective buying power.
So when analyzing your buying power, lenders don't just look at the sticker price of the house. They actually use a crucial four-part formula called PITI. That stands for principal, interest, taxes, and insurance. Your principal is the actual money you borrowed. The interest, that's the cost of borrowing it. But those taxes and insurance are placed into an escrow account and paid on your behalf. Plus, if your down payment is less than 20%, you might have private mortgage insurance or PMI tacked on there too. Lenders are evaluating your affordability based on this total combined monthly expense.
And this all feeds into what the industry calls the 28-36 rule. This is essentially the foundational math of mortgage qualification. Step 1, lenders typically cap your maximum housing costs, that PITI we literally just talked about, at 28% of your gross monthly income. So if you make $60,000 a year, that's $5,000 a month, 28% of that gives you a strict $1,400 monthly housing budget. Step 2 is your back-end ratio. Lenders want your total debt payments, so housing plus everything else, capped at 36% of your income, which is $1,800 a month.
Now, this table brilliantly illustrates how that $1,400 monthly budget stretches in the real world. We pulled this directly from Rocket Mortgage's data based on a 6.5% interest rate. As you can see, with a tiny 3% down payment, your $1,400 monthly budget buys you a $194,000 home. But if you have 20% to put down, you instantly eliminate that PMI and borrow less, meaning that exact same $1,400 monthly payment can now afford a $235,000 home. It's pretty wild, right? The math is totally in your hands.
Section 2. The silent budget killers. Hidden debt factors.
All right, tough love time. We need to address the silent budget killers. These are the invisible financial factors that are secretly destroying your buying power before you even submit an application. Look at this example, the rule of contrast. We have two buyers, both making $60,000. Buyer A drives a paid-off car. Buyer B just financed a new truck with a seemingly normal $600 a month car payment. Because lenders look at your total debt-to-income ratio, that's $600 each directly into the amount of mortgage you can take on. In many cases, that single car payment absolutely obliterates buyer B's mortgage qualification by about $100,000. No joke.
I want to reinforce this shocker with some expert insight from mortgage broker Carol Ann Young. She points out that lenders look at the whole financial picture. That means every regular payment you are responsible for. Even if your student loans are deferred, lenders usually calculate 1% of the total balance as a monthly payment against you. Got credit cards? Even if you pay them off, lenders often calculate 3% of your limits as a monthly debt. These revolving debts are just quietly choking out your mortgage potential. Moving on to Section 3, location, taxation, how geography changes costs.
Now let's introduce the next hidden variable that massively affects your PITI calculation: geography and property taxes. You could literally have the exact same salary and the exact same house price, but where that house is physically sitting changes everything. There is a stark, almost humorous contrast in how local governments treat your wallet. According to the U.S. Census Bureau, if you buy a home in Lake County, Illinois, your effective property tax rate is a staggering 2.50%. Move that exact same budget to Maui County, Hawaii, and your property tax rate drops to 0.14%. That difference doesn't just save you a few bucks, it drastically changes your monthly escrow costs. Basically, in a lower tax state, you can afford a significantly more expensive home on that exact same $60K salary.
Section 4. Boosting your buying power. Maximize your range. Okay, we've looked at the math, and we've faced the harsh realities of debt and taxes. So, how do we actually fight back? Let's rapid fire through some actionable strategies to maximize your target price range. First, boost that credit score. Higher scores unlock lower interest rates, shrinking your monthly payment. Second, and this is a big one, reduce your debt-to-income ratio. Paying off revolving debt like credit cards or a car loan is the absolute fastest way to increase your maximum purchase price. Third, do not sleep on down payment assistance programs. So many state and local governments offer grants that can cover your upfront costs. And finally, consider adding a stable co-borrower, like a friend or family member, to instantly combine incomes and supercharge your loan amount.
You also need to match yourself with the right mortgage product. If you're holding on to the idea that you absolutely must have a 20% down payment, actually scratch that, please let it go. It is a complete myth for first-time buyers. FHA loans allow you to put down just 3.5% and are super forgiving on lower credit scores. If you're military, VA loans offer 100% financing with zero down. There are even innovative programs now like One Plus by Rocket Mortgage, where you only put down 1% and the lender covers the other 2% for you. The tools are out there, you just have to use them.
And of course, we have to remember that current market conditions always play a major role in your affordability. For some context, as of May 2026, data from Freddie Mac's Primary Mortgage Market Survey showed the 30-year fixed-rate mortgage averaging right around 6.36%. You've got to keep a close eye on this because even a drop of 0.5% in the national interest rate can stretch your $1,400 monthly budget by tens of thousands of dollars in buying power.
So here we are at the finish line. You've seen the 2836 rule. You understand exactly how devastating a car loan can be to your pre-approval, and you know how to leverage low down payment loan products to your advantage. A $60,000 salary absolutely buys a house in today's market if you are strategic. You know the math. You know the rules. The only question left to ask yourself is, where will you buy your first home? Thanks for joining me on this explainer. Now go out there and take action on your financial future.